Today, we're going to dive into one single, absolutely chaotic day in the financial markets, March 31st, 2026. A day that basically threw the entire rulebook for how markets are supposed to work right out the window. It was a day of just wild contradictions, and in this explainer, we are going to unpack exactly what really happened.
So this is the central mystery we're going to solve. On one hand, you've got this massive geopolitical crisis grinding global energy supplies to a halt. And on the other, you've got US investors just buying up stocks like there's no tomorrow. It makes zero sense on the surface, but stick with me and you'll get the very strange logic behind all this madness. All right, so here's our game plan. We'll start by setting the scene with a world on edge. Then we'll decode the paradoxical rally. After that, we'll see why this wasn't a global party in a tale of two markets, check out how big companies were playing the corporate game board, and finally, we'll look at the day's lasting echoes.
To really get what happened on March 31st, you have to understand the entire month leading up to it. And it wasn't just one problem. It was like a perfect storm of several crises hitting at once, creating what analysts started calling a polycrisis. Let's look at the biggest piece of that puzzle.
The scale of this thing was just staggering. Think about that for a second. 20%, 1/5 of the entire planet's oil and natural gas supply was just stuck. The Strait of Hormuz was effectively shut down, and it sent these massive shockwaves through the entire global economy.
So this is the environment investors were trying to navigate. You had inflation roaring back to life because of the energy shock. You had completely unpredictable policy decisions coming out of the White House, and all the old rules about how stocks, bonds, and gold are supposed to move together, they were just breaking down. It was, total chaos.
So no surprise here, the market had been getting absolutely hammered for weeks. By the last day of March, both the Dow and the Nasdaq were officially in a correction. The mood was terrible, everyone was selling, and it really looked like the pain was just getting started.
And then the paradox. With this incredibly grim backdrop, the US market suddenly, and I mean suddenly, exploded higher. And the reversal was dramatic. Look at these numbers. The Nasdaq shot up over 2%, the S&P more than 1.6%, and the VIX, which is basically Wall Street's fear index, it absolutely plummeted by over 9%. All the panic that had defined the month just, poof, vanished. But why? The oil was still blockaded.
And here's the key. The rally wasn't based on anything that had actually happened in the real world. It was triggered by a single news report. The Wall Street Journal hinted that the Trump administration was maybe looking for a way out of the conflict. And that tiny glimmer of hope was the off-ramp that nervous investors were desperate for.
But, and this is a huge but, at the exact same time the market was rallying on these hopes of de-escalation, the president was on social media saying things like this. It just shows you the chaotic, contradictory information environment traders were dealing with. Was it peace or was it a threat? For one day at least, the market chose to believe in peace.
But here's the thing. This relief rally was not a global story, not even close. In fact, while the US was surging, other parts of the world were getting absolutely crushed. This was a day of sharp, painful divergence.
Just look at this incredible split between oil and gold. Normally, in a crisis, they're both safe havens, but in March 2026, oil skyrocketed almost 60%, while gold had its worst month in over 17 years. So, what gives? Well, the oil spike made everyone afraid of inflation, which meant the Federal Reserve was likely to keep interest rates high. And that makes holding gold, an asset that pays you nothing, a very expensive bet.
And the most dramatic contrast you'll see is between the US and South Korea. While Wall Street was celebrating this relief rally, Seoul was in the middle of a full-blown crash. Their main index, the Kospi, was in an absolute freefall, its worst month since the 2008 financial crisis. You see, South Korea was uniquely vulnerable, importing about 70% of its oil right through that now-blockaded strait.
And to put a number on that panic, foreign investors yanked nearly 36 trillion won, that's about $23.5 billion US dollars, out of the Korean market in a single month. This was a massive stampede for the exits, a flight away from exposed economies and right back to the US dollar.
Okay, so while investors and traders are glued to their screens riding this insane roller coaster, the big corporations, well, they're playing chess, not checkers. They were making these huge strategic moves to protect themselves in this new high-inflation world.
And the biggest move of them all dropped on March 31st. The spice and flavor company McCormick announced it was merging with a huge chunk of Unilever's global food business. We're talking brands like Hellmann's and Knorr.
This was a monster deal, valued at nearly $45 billion. It wasn't just a simple merger, it was the creation of a brand new global powerhouse in the flavor industry.
And as you can see from this breakdown, once the deal closed, Unilever's existing shareholders would actually be the majority owners of this new company, with McCormick shareholders holding a pretty hefty 35% stake.
So what was the strategy here?
Well, McCormick's CEO basically laid it out perfectly. In a world with high inflation, where the cost of food itself, the calories, is soaring, this was a defensive move. The idea was to own the high-margin part of the business, the flavor that makes those calories taste good. It was all about getting massive to protect your profits.
So what did we actually learn from this one insane day? Well, analysts point to 4 critical, long-term insights that this crisis really brought into the spotlight.
First, the world's energy map got redrawn. Buyers are now looking hard at Latin America to avoid these Middle Eastern choke points. Second, that McCormick deal became the new playbook for corporate strategy: get big to survive inflation. Third, the crisis exposed this emerging kind of sci-fi risk to crypto, the quantum threat, the idea that quantum computers could one day crack its encryption. And finally, the Federal Reserve found itself caught in a trap, risking its reputation as an inflation fighter if it chose to ignore this huge energy shock.
The rally on March 31st showed just how resilient the U.S. market can be, how desperate it is for any piece of good news. But the damage we saw in places like South Korea, the stubbornly high oil prices, and those huge strategic shifts happening in boardrooms around the world, they all tell us that the hard part of this cycle was really just beginning. The market weathered the shock for a day, but the aftershocks, those would be felt for years to come.